Welcome, curious minds, to the deep dive. Ever stop and really think about money? Not just the dollars and cents, but, well, what it actually means.
It's funny, we treat it like this purely logical thing, like math, spreadsheets, charts.
Exactly. But what if financial success isn't really about being a math whiz? What if it's more human, more about how we behave?
That's the core idea we're exploring today. It turns out finance might be less like physics and more, like psychology, full of quirks and emotions.
Precisely. And that's why this deep dive is going to be so interesting. Now, in all the analyses we put together for you, like this one right here, we're actually using some pretty advanced AI-driven book analysis technology.
Yeah, it's pretty cool stuff. It lets us sift through massive amounts of information, pull out the key ideas from great books, and, well, give you the essence without you having to read hundreds of pages. A bit of a shortcut to being well-informed.
Today, that tech has helped us dive deep into Morgan Housel's fantastic book, The Psychology of Money. We're going to pull out the absolute gems.
Right. Our mission really is to get at why doing well with money often has surprisingly little to do with how smart you are and a whole lot more to do with how you act. We'll dig into those psychological forces.
And hopefully give you some really practical, maybe even surprising takeaways, things you can actually use.
Okay, so let's jump in. Housel's main argument, it's pretty counterintuitive for a lot of people. He basically says financial success isn't a hard science, it's a soft skill. Behavior is the driver, not raw intelligence.
Yeah, it flies in the face of the idea that you need like a PhD in finance to get rich.
Totally. And he uses these incredible stories to illustrate it. There's this tech executive he mentions, a certified genius, apparently designed components for Wi-Fi routers, super successful professionally.
But with money, Howells calls it insecurity and childish stupidity. The stories are wild.
Oh, they are. Carrying huge wads of cash, bragging loudly, apparently threw $1,000 gold coins into the ocean just for fun.
Just for fun.
Yeah.
And then smashed a lamp at a hotel. It was worth $500. And he throws $5,000 cash to the manager and tells him to get lost.
Unbelievable. And the punchline. Despite all his brilliance, he went broke.
It's just such a stark example, isn't it?
Yeah.
High IQ, zero financial sense, behaviorally speaking.
Exactly. Now contrast that with Ronald James Reed. Ever hear of him?
The janitor, right, from Vermont.
That's the one. Lived a super simple life. Janitor, gas station attendant, modest house he bought for 12 grand back in the day, chopped firewood for fun.
Seems like the polar opposite of the tech exec.
Completely. But here's the twist. When Ronald Reed died in 2014, it turned out he had a net worth of over $8 million.
$8 million, the janitor. How?
No lottery, no big inheritance. He just saved what little he could manage from his modest paychecks, put it into solid blue chip stocks, and then he waited.
For how long?
Decades. He just let compounding do its thing. Patience and frugality. That was it.
So the genius goes broke, the janitor becomes a multi-millionaire philanthropist. It really wasn't about brains, was it?
Not at all. It was purely behavior. Patience, frugality versus, well, insecurity and stupidity. It makes you realize financial success really is a soft skill.
Okay, so if behavior is key, how do we understand why people act the way they do with money? Also says something interesting. No one's crazy.
Right? Because everyone's financial worldview is shaped by their unique personal history. Your generation, your parents' finances, the economy you grew up in, all that stuff forms like 80% of how you think the world works, even though it's just a tiny sliver of history.
So someone who lived through hyperinflation is going to feel very different about bonds than someone who only knows low inflation.
Exactly. Or think about someone born in 1970, the stock market went up tenfold while they were young. Someone born in 1950 saw it go basically nowhere during those same formative years.
Yeah.
Totally different mental models.
That explains a lot. Even things that seem irrational on the surface, like why lower income folks might buy lottery tickets more often.
Yeah, Housel points out they spend more on lottery tickets than movies, games, music, sports, and books combined, which sounds crazy if you just look at the odds.
But from their perspective,
It's not about the odds. They're paying for a dream. It's an emotional purchase, buying a tangible bit of hope for a dramatically better life, something many others just take for granted. So while maybe not rational on a spreadsheet, it feels perfectly reasonable to them.
that perspective shift is huge. Which leads to another trap. Housel discusses the idea of never enough.
Oh, this is a big one. You look at people like Rajat Gupta or Bernie Madoff. These guys had everything. Money, power, prestige, more than anyone could ever need.
And they threw it all away. Why?
Because they wanted more. Gupta allegedly risked it all for an extra $17 million from insider trading. Madoff built a colossal fraud. They couldn't define enough, even when they were already at the absolute peak.
It's kind of baffling, isn't it? Warren Buffett had that great quote about the long-term capital management guys.
Yeah, the hedge fund full of geniuses that blew up. Buffett said, to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. Simple as that.
So the hardest skill is just stopping the goalpost from moving.
Pretty much. Housel says happiness is results minus expectations, and the problem is social comparison keeps moving those expectations higher and higher. You're always looking at someone with more. It's like that casino dealer saying, the only way to win is to leave as soon as you walk in. Stop playing the comparison game.
And this ties into another really cool idea. Wealth is what you don't see.
Right. We see someone driving a Ferrari and think rich. But Housel talks about the man in the car paradox.
Explain that one.
Well, you see the fancy car and think, if I had that car, people would admire me. But when you see someone else in a fancy car, you don't usually think about the driver, do you? You admire the car. And maybe you use it as a benchmark for what you want.
Huh. So the car inspires admiration for the object, not necessarily the person.
Exactly. And often that visible display isn't even real wealth. He tells that story about Roger, the guy with the Porsche.
Oh yeah, the valet knew him. Everyone thought he must be loaded.
Until the Porsche disappeared and he was driving an old Honda. Turns out the Porsche was heavily financed and got repossessed. The visible wealth was actually a sign of financial instability.
So true wealth is hidden.
It's the nice car you didn't buy because you saved the money instead. It's the diamonds not bought, the vacation skipped. It's financial asset savings, investments that haven't been turned into visible stuff yet.
Most people say they want to be wealthy, meaning they want freedom and flexibility.
But our instincts push us to spend, to show off, which is the opposite of actually building that unseen wealth. Housel compares it to diet and exercise. Getting rich is like working out hard work. Being wealthy is like maintaining a healthy weight. It requires discipline, restraint, creating that gap between what you could spend and what you actually do spend.
That makes sense. Okay, let's shift gears slightly to compounding. Housel has a unique take here too, right? It's not about brute force.
Not at all. It's about time. He uses this amazing analogy of ice ages.
Ice ages. How does that relate?
Well, you'd think ice ages are caused by incredibly freezing winters, right? But geologists say it's more about summers that are just moderately cool enough that the previous winter's snow doesn't completely melt.
So a little bit of snow sticks around each year.
And it builds up year after year, century after century. That tiny, persistent difference, snow not melting, compounds over time into massive continental ice sheets. Small change, huge long-term result.
Wow. That's a powerful way to think about it, like Warren Buffett.
Exactly. People point to Jim Simons at Renaissance Technologies, whose annual returns are like unbelievably high, 66% versus Buffett's 22%.
But Buffett's richer.
Significantly richer, yeah. Because Simons only started his fund later in life. Buffett, he started investing when he was 10. He's had 3/4 of a century for that 22% to compound. His secret isn't just skill. Housel says his secret is time.
So good investing isn't necessarily about hitting home runs every year.
It's about earning pretty good returns, Housel says, that you can actually stick with for the longest possible time. He jokes that the best investing book title would just be Shut Up and Wait.
Huh. I like that. But waiting only works if you, well, survive, right?
Mm-hmm.
That brings us to staying wealthy.
Crucial point. Getting rich can happen in many ways: luck, risk, skill. But staying wealthy, Housel argues there's really only one way. Some combination of frugality and paranoia.
Paranoia. That sounds intense.
It means being deeply aware of risk, especially the risk of ruin. You have to avoid blowing up because compounding needs an uninterrupted runway. If you get wiped out, the game's over.
Like Jesse Livermore, the famous trader, made a fortune in the 1929 crash.
Made the equivalent of billions. But then he got overconfident, kept making bigger and bigger bets, took on too much risk, and eventually lost it all, died broke. His genius couldn't save him from his own behavior.
And that contrast with Rick Guerin Buffett and Munger's early partner.
Yeah, Guerin was just as smart, apparently, but Housel says he was in a hurry. He used a lot of leverage, got caught in a downturn in the 70s, faced margin calls, and had to sell his Berkshire Hathaway stock back to Buffett for pennies on the dollar.
Ouch. So Warren and Charlie had the extra skill of just sticking around.
They survived. Buffett's genius is partly in what he didn't do. He didn't get ruined by debt. He didn't panic sell in crashes. He didn't destroy his reputation. He didn't get stuck on one strategy. He just endured. Longevity was key.
So how do you apply that, this survival mindset?
Practically, it means prioritizing being financially unbraidable over chasing the absolute highest returns. Holding the cash, for instance. It feels conservative, maybe even inefficient.
Right, because cash doesn't grow much.
It prevents you from being forced to sell your stocks or your house during a downturn just to pay the bills. Avoiding those forced sales in bad times can actually boost your long-term returns more than picking a few extra winners.
It's about having options when things go wrong.
Exactly. Planning on the plan, not going according to plan. Having a margin of safety or room for error. It's not about avoiding risk. It's about ensuring you can survive the risks that inevitably go bad, because growth always happens alongside setbacks, wars, recessions, you name it.
It also means accepting that failure is normal, right? Even common.
Totally normal. Housel brings up great examples. Disney Snow White was the massive hit, the tale that basically saved the company after hundreds of less successful cartoons. Venture capital, most startups fail, but a tiny few produce almost all the returns.
Even Jeff Bezos at Amazon talks about needing bigger failures.
Yeah, because the wins, when they happen, need to be big enough to cover all the misses. Even Buffett admits most of his lifetime gains came from just like 10 stocks out of the hundreds he's owned. You don't have to be right often. You have to be right big when you are.
Okay, this connects to another point, the power of saving. You said it's the most controllable lever.
Absolutely. Think about energy. The U.S. gained more energy wealth over the last few decades from efficiency cars getting better mileage, better insulation than from drilling more oil. We reduced the need more than we increased the supply.
And that efficiency part is something individuals and companies could control.
Exactly. Same with your money.
Nice.
You can't fully control investment returns, market swings, or interest rates, but you can control how much you save. Your savings rate is far more predictive of building wealth than your income level or your investment strategy.
You can get wealthy on a modest income if you save a lot, but not on a high income if you save nothing.
Precisely. Because wealth is relative to your needs. And Housel makes this sharp point. Past a certain income, what you need is often just dictated by your ego, keeping up appearances.
So less ego, more wealth.
Basically, yeah. Humility lets you save more. It's a constant battle, though. But the payoff isn't just a bigger bank balance. The real, incalculable return on savings is freedom, flexibility, control over your time.
Being able to walk away from a bad job, or wait for the right opportunity, or handle an emergency without stress.
That's the ultimate dividend money pays. And in today's world, where intelligence alone isn't always enough, that flexibility is the sustainable advantage.
This all really emphasizes the human side, which brings us to Housel's idea that we should aim to be reasonable rather than purely rational.
Yes. This is such a key insight. You're not a spreadsheet. You're a person with feelings, fears, regrets. Coldly rational decisions are often impossible to stick with long term.
He uses that wild example of the Nobel Prize winner who treated syphilis with a...
Wagner, Jareg, yeah. Inducing high fevers with malaria actually worked against syphilis. Rationally, it was effective. But people hate fevers. They feel awful. So we take Tylenol. We fight the fever, even if it might be medically useful, because feeling bad is, well, unreasonable to endure if you don't have to.
So our desire to avoid pain or discomfort overrides the rational path.
Often, yes. Even Harry Markowitz, the guy who won the Nobel for modern portfolio theory, didn't invest his own retirement money according to his complex models. He just split it 50 stocks and bonds. Why? To minimize future regret. It wasn't mathematically optimal, but it was emotionally reasonable for him.
You wanted to sleep at night.
Exactly. That's why Housel even suggests it's okay to love your investments, even if it's not perfectly rational. That emotional buy-in helps you stick with them through thick and thin, which is rational for long-term compounding.
It also means acknowledging that the world is, well, surprising. History isn't a perfect predictor.
Right. Scott Sagan's quote, "Things that have never happened before happen all the time." Financial history is tricky because, unlike physics, the participants' people have feelings and memories and change their behavior. The rules aren't fixed.
So relying too heavily on past data can be a trap.
It can be. The world changes. Think about it. 401ks are relatively new. Venture capital, as we know it, barely existed 25 years ago. The companies in the S&P 500 are totally different now. Michael Batnick had that clever line.
The one about it's different this time.
Yeah. The 12 most dangerous words in investing are, the 4 most dangerous words in investing are, it's different this time. It mocks the original phrase while acknowledging that sometimes things do change fundamentally. The lesson from surprises, as Daniel Kahneman said, is simply that the world is surprising.
And we seem weirdly drawn to pessimism, don't we? Housel talks about the seduction of pessimism.
It's true. Bad news travels fast, and pessimism often sounds smarter, more serious. Optimism can sound naive. Imagine predicting Japan's post-WWII economic miracle back in 1945. People would have laughed. But it happened.
Why are we wired that way?
Evolution, probably. Loss aversion is strong. Avoiding threats kept our ancestors alive. And money is everywhere, so bad financial news feels universally threatening. Plus, progress is slow and often invisible, like decades of declining heart disease, while setbacks are sudden and dramatic market crashes, disasters. Pessimistic narratives are just easier to build and believe.
It also ties into believing things we want to be true, especially when we feel out of control. Appealing fictions, he calls them.
Yeah, like the Yemeni father willing to try a folk remedy for his sick child because he felt desperate. In finance, it's believing the TV pundit with no track record, or maybe why Madoff got away with it for so long. People wanted to believe in those steady, impossible returns.
We fill in the gaps in our knowledge with narratives.
Exactly. We all have incomplete views, but we create complete stories in our heads, which leads to overconfidence. That's why defining the game you're playing is so critical. Are you a long-term investor or a day trader? Knowing your own goals and time frames stops you from getting panicked by others playing a totally different game.
Okay, so wrapping this all up, what are the most actionable takeaways from Housel?
He lists a bunch in the book, kind of distilling it down. A big one is humility and compassion recognize the role of luck and risk in your own outcomes and others. Less ego equals more wealth. Remember, wealth is what you don't see.
Manage your money primarily to sleep well at night. Peace of mind over purely rational optimization.
Right. And be okay with things going wrong except the tail dynamic. Focus on your overall portfolio, not every single investment. Use money mainly to gain control over your time. That's its biggest payoff.
Be nicer and less flashy than you could be. Save money just because without a specific goal, that savings buys you invaluable options.
Accept volatility and fear as the price of admission for market returns, not a fine for doing something wrong. Worship room for error. It keeps you in the game. Avoid financial extremes because you'll change, and extreme plans breed regret.
Like risk, but be paranoid about ruinous risk. Define your game and just respect the mess. Understand that smart people make weird decisions because emotions and unique perspectives are always involved.
And Housel himself lives this. He aims for independence, not being rich, keeps his lifestyle modest, paid off his mortgage even though mathematically maybe he shouldn't have, holds lots of cash for flexibility. It shows there's no single right answer, just what works for you.
Wow. This deep dive really flips the script on how we usually think about money, doesn't it? It's so much more about our psychology, our behavior, our own stories.
Absolutely. It brings the human element front and center, which is often missing from purely technical financial advice. Understanding ourselves seems just as important as understanding markets.
So we hope this look into the psychology of money has sparked some thoughts for you. Here's one to maybe chew on. Given how much we all change over time and how unpredictable the world is, what's one financial belief you hold firmly today that your future self might look back on and find, well, completely unreasonable? We'd genuinely love to hear your reflections on that.
Yeah, let us know in the comments. And if you found this conversation valuable, please do give this deep dive a like, maybe share it with a friend who'd find it interesting.
Your engagement really helps us keep exploring these fascinating topics and bringing these AI-powered insights to you. Thanks for joining us on the deep dive.